Welcome back to Simple Mind Space, the podcast dedicated to helping you master your money and your mind. Today, we're diving into the fascinating world of the stock market, exploring the delicate dance between economic indicators and investor sentiment. Recent market activity has been a whirlwind, with tech giant NVIDIA at the epicenter. Despite posting impressive earnings that surpassed expectations, the market reacted with a shrug and a sell-off. This begs the question, why the lukewarm response to seemingly stellar performance? Let's break it down. NVIDIA, often seen as a bellwether for the tech industry and a major player in the artificial intelligence AI field, has enjoyed a string of blowout quarters. However, the sheer magnitude of these wins has created a situation where anything short of astronomical growth is perceived as a disappointment. Imagine a track star consistently shattering world records. At some point, the bar is set so high that even a victory that would be considered remarkable by any other standard feels almost mundane. This is the conundrum facing NVIDIA. While their recent earnings were undoubtedly strong, they didn't quite reach the stratospheric levels investors have come to expect. This phenomenon speaks to a broader trend in the market, the constant hunger for exponential growth, particularly in the tech sector. While this desire for innovation and expansion is understandable, it also creates an environment where sustainable growth can be overshadowed by the pressure to constantly outdo previous achievements. Adding another layer of complexity to the equation is the current economic landscape. Despite the stock market's recent buoyancy, storm clouds are gathering on the horizon. The labor market, a crucial pillar of a healthy economy, is showing signs of softening. Hiring rates are slowing, wage growth is stagnating, and job losses are ticking upward. This economic reality clashes with the optimism reflected in the stock market. It's like attending a lively party where upbeat music and cheerful chatter mask an undercurrent of anxiety and uncertainty. Investors, it seems, are torn between the allure of a potential market rally and the nagging feeling that economic fundamentals don't quite support the party atmosphere. So, how do we reconcile these seemingly contradictory forces? The key lies in understanding that the stock market is not always a perfect reflection of the underlying economy. Investor sentiment, often driven by short-term factors and emotional responses, can create temporary disconnects between market performance and economic reality. This is where a balanced, long-term investment strategy becomes paramount. While it's tempting to chase the latest hot stock or get swept up in market hype, it's crucial to build a portfolio that can weather economic storms and deliver sustainable returns over time. This means diversifying your investments across different asset classes, such as stocks, bonds, and real estate. It also means incorporating defensive strategies, like investing in consumer staples companies, which tend to perform well even during economic downturns. These companies produce essential goods and services that people continue to buy even when tightening their belts. Think of household names like Walmart, Coca-Cola, or Procter & Gamble, brands deeply ingrained in our daily lives. Don't forget about fixed income securities like bonds. While they might not offer the same potential for high returns as stocks, they provide a level of stability and consistent income that can be invaluable during periods of market volatility. In essence, navigating the current market environment requires a delicate balancing act, acknowledging both the potential for growth and the very real economic challenges that lie ahead. It's about tempering enthusiasm with caution and short-term speculation with long-term vision. Remember, investing is a marathon, not a sprint. By focusing on building a resilient portfolio and staying informed about both market trends and economic indicators, you can position yourself for success no matter what the future holds. If you enjoyed today's deep dive into the intersection of market dynamics, economic realities, and sound investment strategies, be sure to like, subscribe, and share this episode with your fellow investors. Until next time, remember to invest wisely and live fully.